Hey everybody, it's Daniel here from InfoRest. Hope you're all doing well. So, it's been a while, but we got to talk about the last jobs report, the non-farm payrolls report that we got. Came out worse than expected, where the jobs number came out bad and the revisions even worse. And we had also the inflation average hourly earnings component come in higher. We also saw that not only when this number came out, we saw a big move up higher in the bond market and stocks to sell off. And we got a very interesting reaction from President Trump coming out and firing the commissioner, the head of who manages these numbers. And it makes you think, what's going on, right? We heard from Trump talking about that these numbers are manipulated, they're not real, and during Biden's time they did this, and during his time, they're making the economy look bad. But is this the truth? Who do we believe, Trump or these numbers, right? Because everybody's, at the end of the day, has got their own agenda. And if you look at it, right, even though maybe Trump may be right about certain things, like, for example, how calculations are done on these reports, it may not be the best and accurate way, especially when you look at the unemployment rate. It ticked up a little bit, but it's still in the 4% range. It's still looking, everything is hunkadoris and fine. You start to question whether these calculations are being done properly, whether we should look into how we are calculating these things and revising these things, right? Because the last report, the revisions there, in the last jobs report, it came in amazing, right? Because this many government jobs were added and et cetera, et cetera. And then in last week's report, we basically saw that number drastically dropped lower, basically signifying that the last jobs report was incorrect. So this is the real number, and it's actually worse than expected. And that the economy and the job market is not as hunkadoris or good as people expect. So, what do you do in such situation? Well, first of all, I do agree with some of the things that Trump have said, that the numbers in the calculation are not the best, and how they calculate things can be manipulative as well, and it's not accurate, right? Especially when you're double counting jobs in the NFP report, when you should be really, if you're looking at it, you should be really looking at, if someone's working two jobs, count it as one. Why count it as two, right? There's things like that. Then there's things like how you're, counting people in the unemployment rate or the labor market, right? For example, if you're doing a survey and you're surveying people saying that, hey, have you been unemployed? For how long have you been unemployed? Are you looking for a job? And they're unemployed. They were looking for a job, but they've stopped temporarily. Maybe they're discouraged. Maybe they're taking a break. And then all of a sudden you decide to take them out of the labor market numbers. That's also not depicting the numbers perfectly here. So for sure, 100%, there's lots to say about how these numbers are calculated and how they can be much better. But at the same time, in the same token, coming out and basically firing left and right, I mean, that's his style, right? Is that the best move? Is that the best thing to do? It does raise eyebrows and question marks that, it may look also that you are trying to create numbers that look good for you as well. Even though you may be right, but, how can we be sure that you won't be manipulative also when it comes to firing and putting someone there to make the numbers look good, right? So there's all these questions and unknowns, and who do you believe? What do you look at, and how do you go about doing, figuring out whether the economy is doing fine or not? Well, first things first is that when you look at the non-farm payrolls report and you look at the establishment versus the household report, and you look at the trends, and you look at past history, and you put everything together from yield curve to unemployment rate to historical unemployment rate to historic trends of household reports, one thing's for sure is that when you see that the unemployment rate tends to be close to the 4% level, that tends to be the max. It can't get better than that. You'll never get, 0% unemployment rate. It's just not possible. So that tends to be the max. So if you're at the max, right, what do you think happens? It can't really get better. So then it could get maybe worse, or a little bit worse, or a little bit bad, right? Which means that the only direction here for the unemployment rate is moving up. Now the numbers tend to be lagging also. So it takes time and how they're calculated and the misrepresentation and all that stuff, right? So what do we look at? We can look at yield curves. We can look at, what the markets are pricing in terms of rate cuts, what's happening from a fiscal and monetary policy point of view, which we all, which I discuss on this channel and even in my courses and in the Discord chat room. If you're interested, take a look. Links are in the description. But when it comes to understanding all of this, definitely we can see that the yield curve, we are seeing steepening there. We are seeing the bond market and the money markets pricing in that, there's a probability that we're going to get a September rate cut. And we still have some more jobs data and more data to view and see before that meeting in September comes in, and before even Jackson Hole event in August, we could hear a signal there. And we know Powell has been adamant about keeping rates where they are and not cutting too soon because of fears of inflation reigniting again because of all this tariff situation, right? Although we heard certain Fed members come out and say that this tariff thing is a one-off and it's temporary and we're going to see, inflation get better. You can look at many arguments out there, positive or negative, right? Whether, we're going to see inflation, we're not going to see inflation. AI is coming in, that's going to create deflation. We're going to see a recession, deflation. Recession plus AI, deflation. So no inflation. Tariff is a one-off thing, just a quick tax. And then we're going to see prices come down because consumers are not buying that much. And then we see the unemployment moving up. So there's so much you could say. But for now, with everything we're seeing right now, definitely there's signs of weakness and cracks. Definitely we're seeing from tech companies out there layoffs. But the markets and the economy is still plugging along, or at least the stock market is still plugging along. And we're seeing a move up higher in the equity markets and completely, disregarding all this negative news. Because if there's negative news and negative jobs and whatnot, then that means rate cuts. And rate cuts come, then great. That's good for businesses and things will get better, right? Or you look at history and see that when we see rate cuts, after pausing some time, right? We had rate cuts, then we paused, then we get rate cuts again. And then when you see emergency rate cuts, then you know something tends to not be good during that time. Now, however, this is all probabilities game, right? History may suggest that there's a high probability that we tip into recession, but there are instances in the past where we have seen where this such scenario of rate cuts and then aggressive rate cuts and the yield curve inverting and then that signals a recession and then it not happening definitely is there. There has been scenarios like that. So you have to be kind of diligent and aware of all the scenarios and all the possibilities and be open to both possibilities happening, whether bearish or bullish, whether markets go down or up. And you have to strategize and think from your point of view what is best in terms of where you are in terms of your age, your risk tolerance, your time horizon, and what have you. What backup plans should you have? Maybe you should think of some backup plans. What should you do to allocate some risk here so you don't miss out on any moves that might be happening, right? But if I were to look at all this and put it all together, definitely there is some weakness in the economy. It's not as bad as other countries, like when you compare it to Canada. Canada's way worse off. But in the US, it is plugging along much better than let's say Canada. And when you look at the economy slowing down and showing some weakness, you might be scratching your head and wondering about, okay, why is the stock market moving up higher? Why is Nvidia moving up higher and all-time highs? What's going on? That's when you have to do a little bit more digging and understand that there are other plays here, and especially not just from monetary policy. Nowadays, we have to really consider fiscal policy, right? This is what Trump is doing, what he wants in terms of not only rate cuts, but money printing and money pumping and whatnot, right? We've seen that Fed Kugler has resigned. And two of the Fed members basically dissenting and saying that they want to see some sort of rate cut. And that Powell's job is up for grabs next year as well. So we're seeing a shift where Trump is trying to put a team of dovish members to bring prices down and start money printing, right? So from now till that happens, if there is some sort of crash or recession or downfall or whatever, we know what's coming. Whether Trump puts a new team of massively dovish members or not, you're eventually going to get the rate cuts. You're eventually going to get the money printing, which means there might be short-term pain for gain, or if it doesn't happen and you get this change in the Federal Reserve, and you get Fed members, and you get the cuts, and you get the money printing, then we know we're also going to see a move up much higher, right? So sometimes markets can remain irrationally longer than you and I can remain solvent. Sometimes, the markets and how the economy is acting are on different footings, and there are many, many reasons for that. But what we can see for now and for sure is that there's no tantrum or fear as of right now in the equity markets. However, the economy might be worrisome, but it doesn't mean it's going to pull stocks down all of a sudden. It may happen, it may not happen, it may take its time, but you got to go ahead with the theme in the equity markets, the price actions that are happening in the equity markets, and get your answers, or just listen simply what Mr. Market is telling you, as Warren Buffett likes to put it. What Mr. Market is providing you. What are they giving you? What are the reactions when you do see pullbacks? We did see a pullback, just last week, right? Or just a couple of days back. And now look at it. We're moving higher. We heard about Apple investing another $100 billion into U.S., right? For creating a manufacturing plant. And we heard that, we're going to see exemptions for Apple when it comes to tariffs. And now look at Apple's pushing up higher. Nvidia pushing up higher because you got CapEx from a lot of these big fan companies. They're increasing their CapEx, and that's good for Nvidia. So even though all this trade war and tariffs that are happening and that people might be fearful of, you still see the stock market moving up higher and higher, and it may continue to do so until you get some sort of surprise moment, black swan event, or what have you. And especially when you look at how people are still fearful and people are still on the sidelines, it creates more room for risk assets to move up higher. The only question is how long do we go up for? How high do we go? How bad are the pullbacks? How bad are this potential recession coming or not? And if we do get pullbacks, is it quick? Is it fast? And what is the reaction from not only monetary side of things, but also let's not forget the fiscal side of things that have a play here. So anyways, very interesting to see everything come together from the NFP report, the reaction from Trump, what's happening on the Fed side of things. Definitely you do see a push for easing, especially from the Trump administration, and which is essentially good for the equity markets and also for bonds too, right? If you're going to get those aggressive rate cuts, money printing and so forth, just like we saw during non-farm payrolls, you can expect bonds to move up higher if that continues to be the theme. Now, in terms of inflation, time will tell with everything that's coming out, especially the data. The last two data points of ISM and non-farm payrolls showed that prices were a little bit higher, but we want to see continued trends of it to start worrying about any kind of inflation issues reigniting. But until then, let's see what happens. Let me know what you guys think. Leave a comment below, subscribe, hit the like button, bell icon to be notified in the next video, and I'll see you guys around. Cheers. Bye.